Is it better to DCA or lump sum into Bitcoin? Well, in today's video, I'm going to be answering exactly that, and some of the results might just surprise you. I've tested both strategies across multiple timeframes, from cycle peaks to bear market lows, to see which one really comes out on top. So let's get into it. There's always a lot of debate about whether dollar cost averaging or lump sum investing is the superior strategy. And I'm not here to argue the merits of either. Instead, we're going to look at what the hard data is telling us. We'll compare these two strategies across different timeframes, 5 years, 10 years, and even scenarios where you invest at the absolute cycle tops and bottoms. We'll run all of these examples with a simple $10,000 investment. In each case, we'll either deploy the entire $10,000 up front as a lump sum, or we'll spread it evenly by investing weekly. So let's start with the most obvious example, and most of you can probably guess where this is heading. Back in 2011, one of the earliest possible points with reliable price data, a $10,000 lump sum investment would now be worth over $124 million, with an average cost basis of just $9 per Bitcoin. If instead we dollar cost average that $10,000 over the years, it would have grown to an equally eye-watering amount of $22 million, with an average cost of $53 per Bitcoin. Not bad at all, but it's still miles behind the lump sum approach. Now, let's zoom in a bit and look at the 10-year time horizon, which avoids some of Bitcoin's early parabolic growth. A lump sum investment of $10,000 back in 2015 would now be worth around $4.4 million, with an average cost of $264 per Bitcoin. If we instead spreaded that same amount over a weekly time frame for 10 years, it would be worth just over $500,000 today, with an average cost of $2,300 per Bitcoin. So again, lump sum significantly outperformed DCA. Now, even over a shorter 5-year period, the pattern remains the same. A $10,000 lump sum from 5 years ago would now be worth $100,000, with an average cost of $11,000 per Bitcoin. The same amount DCA'd weekly would have only grown to $35,000, with a much higher average entry price of $33,000. So far, we've tested 3 timeframes, 5 years, 10 years, and the entire Bitcoin history. And in every single one, lump sum investing hasn't just beaten DCA, it's absolutely crushed it. But is there a situation where dollar cost averaging actually works better? Well, let's imagine you invested your entire $10,000 lump sum at the absolute top of the prior cycle peak in November 2021. That investment would be worth just $18,000 today, and it would have taken a few painful years to just break even. On the other hand, dollar cost averaging over that same period would have produced a portfolio worth $33,000. Now, this is where DCA shines. In bear markets where prices continue to decline, slowly buying over time dramatically reduces your average cost and spreads the damage over those many painful months. But let's say instead of ending the test after just one cycle, you extend your time horizon out a bit. Let's use the previous cycle peak in December 2017. A lump sum investment at the absolute peak of this cycle would have been underwater for quite a while, just like in the previous example. But by staying the course and allowing the next cycle to play out, the portfolio would have grown to $68,000. Now, surprisingly, DCA over that same period would have returned $82,000. So yes, it outperformed, but not by much. Considering the lump sum investor bought the absolute top again, you'd expect DCA to absolutely crush it, but it didn't. By extending your time horizon beyond the current cycle you're in, it really doesn't matter if you are unlucky enough to buy the absolute cycle peak. Now finally, let's flip this scenario and imagine we invested right at the very bottom of the cycle. In this case, to no surprise, lump sum wins again, turning into $72,000, while DCA got you to just under $30,000. This one's no shocker, but it's worth confirming just the level of outperformance. So what's the big takeaway from all this? Well, if you're planning to invest over a multi-year or multi-cycle time horizon, lump sum investing has historically outperformed in nearly every scenario. It's only when you throw your entire bag of cash at the top of the euphoric cycle that you get burnt. And even then, if you're willing to hold out beyond a single cycle, the performance gap starts to shrink over time. That said, DCA still has a very real place in a solid investment strategy. I actually personally run a small automated DCA that invests daily for me, even though I know based on this, lump sum will likely perform better. I do this because investing isn't just about numbers, it's about managing your emotions as well. Most people think that they'll never buy the top until they do. I analyse Bitcoin metrics daily, and I even know that I'm not immune to the same psychological traps as everyone else. Bitcoin is the best performing asset in history, yet I've been caught waiting for a dip, only to be left behind and forced to buy back in at a higher price. My daily DCA helps me ensure that I'm always increasing my sats every single day, even when it doesn't feel optimal to do so. Of course, on top of that, I also do lump sum investing, but that requires trying to time the market using metrics that suggest when Bitcoin is undervalued, either locally or on a macro scale. Some call this dynamic DCAing, and it's a pretty powerful concept. I always invest something regularly, but I double or triple down when the data tells me there's a compelling opportunity. Now, I'm not saying this is the only strategy you should follow, I'm simply showing how I think about it. For most people with a regular income, DCA makes a lot of sense. And if you can consistently tuck away 5 to 10% of your paycheck each month, regardless of the price, you'll already be way ahead of the majority of investors. Ultimately, it doesn't matter whether you strictly follow a DCA, lump sum, or your own complex hybrid of the two. What does matter is that you take action and stay consistent. Because if your time horizon is long enough, the strategy you implement becomes less important than your commitment to the process. So, to wrap things up, when we backtest our results, it's clear that lump sum investing has historically delivered the best results over almost every time frame, especially when you zoom out over multiple years or market cycles. That said, dollar cost averaging still plays a valuable role, particularly in bear markets when prices are falling and emotions are running high. It can smooth out the volatility and help you avoid the psychological trap of trying to time the absolute bottom, which, let's face it, almost all of us get wrong. What also really stands out, though, is just how important your time horizon is. If you're able to stretch your investing period beyond a single cycle, even if you happen to invest at a cycle peak, the long-term returns tend to even out. Bitcoin's explosive growth means that, given enough time, even poorly timed entries can become highly profitable. And finally, none of this works without consistency. You don't need the perfect strategy, you just need one that you can stick to. Whether that's DCA, lump sum, or a mix of the two, the key is to keep showing up. It's not about catching the absolute bottom or avoiding the top. It's about staying in the game long enough for the numbers to work out in your favour. I hope you found this useful. If you're serious about Bitcoin analysis, my full custom indicator suite is now live. Built for investors looking to gain an edge through deep cycle signals and advanced on-chain insights. It's available now through the link in the description, where you'll also find my free newsletter. And if you found this valuable, hit the like button, subscribe to the channel, and turn on notifications so you never miss an update. And I'll see you all in the next one.